This advice is general and does not take into account your objectives, financial situations, or needs. You should consider whether the advice is suitable for you and your personal circumstances. Before you make any decision about whether to acquire a financial product, you should obtain and read the relevant product disclosure statement. Hello, my name's Patrick Malcolm. I'm a senior partner and financial planner at GFM Wealth Advisory. I'm joined by Sean Roger from Perpetual today. Thank you for joining us, Sean.
Thanks very much for having me.
Elephant in the room before we get started. They say never trust a man with two first names. We've got a Sean Roger and a Patrick Malcolm, which is not a good start. We're going to get over that?
We will get over it.
That's good. Okay, so just to start with, congratulations on your appointment to the co-portfolio manager role at PIC. So maybe just to start with, can you give us a little bit of your background and how you've progressed your career to this point in time?
Yeah, sure. So I joined Perpetual in 2013 as a graduate accountant straight out of university. And then it was about a year after I joined that I took part in a program that's run by the equities team where they give, I guess, people from the rest of the business an opportunity to come and learn a little bit about how the team works and how, I guess, investing works. And through that program, I guess I got to know a few people in the team and that opened up a door to join the team as a equities dealer about 12 months after that. And then from there, I guess that program really sort of sparked my interest in investing. Before that, I didn't really know exactly what I wanted to do, but seeing some insight into just the world of investing, that was really, I guess, the start of it all. And after 12 months or so as a dealer, I moved off to become an analyst for the broader team, covered a range of different sectors. And then it was about 2017 or so where I got the opportunity to move on to the long-short products as a dedicated sort of analyst on the short side, which was a really interesting few years, I guess, learning out the world of shorting and different ways of looking at stocks and risks associated with that. And then from there, it was about 2021 that I moved into a deputy portfolio manager role on the two long-short products. And early this year, moved to a co-PM role on those long-short products and joined the PIC with Vince as well, which has been a lot of fun over the last few months.
2013, that makes you how old?
33.
Nice to be interviewing someone younger than me, which is really good. What excites you about your job on a day-to-day basis?
Look, I think it's just such a dynamic role. So I often say to my wife when I get home, I've gone in on Monday morning with a list of things I need to do for certain stocks or projects I want to do. And almost every week you come home and I've ended up looking at something completely different. And whether that be because there's been a big stock announcement or a merger acquisition or a capital raising that sort of popped up, invariably you end up looking at things that you just never thought you were going to be that day. And I think that really dynamic and sort of keeps you on your toes and something that I really enjoy. Also, I guess, especially working for Perpetual, it's a big fund. We are in the privileged position of being able to get to meet a lot of companies and spend a lot of time with management teams. And we've got some fantastic business people in Australia and leaders of these companies, and being able to speak with them, learn how they think about their business and respond to different challenges is really, really interesting and valuable. And I guess my role, having exposure to the long-short products and also the PIC, really gives me insight into a broad range of market caps. And all the three products have got an ability to go offshore and the shorting aspect of it as well. There's lots of different ways to reflect views in a portfolio and try and make money for clients. So, I think it's very dynamic, and having that wide range of set, it keeps me on my toes.
That's
so
good.
I enjoy that.
Can't imagine 2 days are the same.
Absolutely not.
No. The Perpetual investment philosophy, Sean, well known, understood. Can you just talk us through the Perpetual investment philosophy for our clients that maybe don't understand it?
Yeah, of course. So look, the two core sort of pillars of Perpetual's investment philosophy are quality and value, and the combination of those two together. And for any stock to be investable in any of our long portfolios, it needs to pass our quality filter process. And that's a process that's been in place for decades and has been proven through different cycles and over long periods of time. Those four quality filters, just to touch on them, there's a balance sheet filter, so there's certain metrics that a company needs to pass. There's a recurring earnings feature, so the company has to be profitable. There's a quality of management view, and again, subjective, but something that we put a lot of emphasis on. And you'll see that in a lot of our investments. We love investing alongside founders and high quality management teams. And the fourth one is just the actual quality of the business, looking at the different things like position within the industry and overall industry growth and those sorts of things. So once a company then passes those filters, it's something that we can invest in within the funds. And I think the outcome of having a filter process like that is we tend to be invested in real businesses that generate cash flow. And that means that we won't be invested in the new hot technology that's not earning money but has a potentially very large blue sky narrative. So when there's, I guess, the market's on and running and chasing those sorts of stocks, we tend to lag a little bit, but then vice versa when you get the inevitable sort of bubble on the other side popping, whether that's the buy now, pay later in 2022 when you had interest rates rise. I guess those filters put us in a good place to protect capital in that environment.
Give us a quintessential stock that fits the Perpetual investment philosophy.
Yeah, so I think one, looking back over the last few years, that has been a successful investment was Goodman Group. I'm sure many people have heard of Goodman Group and know it, but basically for those that don't, it's a developer, manager and owner of logistics and digital infrastructure assets across the globe. And it's got a lot of qualities that we really like in a company we're invested in. It's founder-led. It's got Greg Goodman's an excellent operator, and he's got a very good team under him. They've got complete strategic clarity. They know what they are. They aren't running around going into different asset classes or different property sectors. They've got a phenomenal track record of execution. And they always run with a very conservative balance sheet relative to their peers, which we really like. We hadn't owned the stock for a long period of time. During 2020 and 2021, when interest rates were heading lower and very close to zero, Goodman was trading on a very elevated multiple and had a really good run of it. Late 21, early 22, when we started to see signs that inflation was not going to be transitory and that we were likely to head into a rising rate environment, Goodman, along with a lot of the other property stocks, sold off quite heavily. And the concern from the market was that as interest rates rise, initially or over time, you would then get a response where overall consumer demand would soften. It's a logistics business, less goods flowing through their sheds, might put pressure on vacancies. Higher interest rates often then also lead to lower asset values as capitalisation rates increase. And for Goodman as a fund manager, if asset values start falling, it's not good. It means that the performance of the funds, they're not earning as many performance fees, their management fees drops. That was the concern of the market. What we were sort of looking at was, on one hand, the business was set up very, very well from a capital perspective heading into that downturn. So if we did get a proper period of stress in the industry, Goodman's very low gearing relative to peers meant they were in a perfect position to be able to capitalise on that and come out the other side in a stronger position. And they also had a very, very big backlog of performance fees that were due to be released over the next few years. So we felt that provided a bit of a buffer from an earnings perspective to any pressure from the higher rates. So for us, the stock fell from $27 down to sort of $17 or $18. Was trading on 17 or 18 times PE at that point. And for us, that was an attractive value opportunity in a high-quality company that we expected was going to continue to grow over the long period of time. So I think that's a good example of an opportunity where it's a really high-quality company at a value price, and we love those opportunities. I think that's what we look for.
And that sort of picks up on the next point here. All managers talk about buying quality at the right price. Goodman's probably a really good example, but maybe another example of how Perpetual looks at quality and value in terms of buying it at the right price?
Yeah, I think that's spot on. And look, I think buying quality at the right price is something that a lot of investors try to do.
Rolls off the tongue, doesn't it?
It does roll off the tongue. And I have a bit of a contrarian mindset to investing and don't like to sort of be fishing where other people are. But my experience is that if you can pick up a quality company at a value price and you can overlook some of the, I guess, risk factors as to why that's trading a bit lower, it's a really good way of making money long term. So I do agree with that premise. In terms of quality for me, what I actually look for, and everyone has a different view on what quality is, but I spend a lot of time on where does the business or the company sit within its industry. So its brand power, its position with customers, which ultimately drives its pricing power. The second one is the sustainability of the industry it's in. And for me, it doesn't necessarily need to be an industry that's high growth. It can be one that's not growing much. But I think you don't want it to be an industry that's going backwards at a rate of knots, because even if a company's then growing market share, that's a tough environment to be operating in. And the third thing is just looking at the financial metrics. How much capital do they need to grow? What's the return on the capital that they're putting to work? But the final thing I think, which is a big part of looking at quality, is an assessment of the management team. And I think you can have a high quality company, but with poor stewardship, that can be a bad investment. So we spend a lot of time looking at the management, their capital allocation, how clear they are on their strategy. Are they looking around corners trying to, I guess, see what risks are coming? And that really adds to the sustainability of the business model. So I think that's how I look at quality. And then for me, value is, I guess, an outcome of your view on the quality of a business. And I think there's often a bit of a misperception out there that value investors don't like growth.
Yes, absolutely.
I would much prefer to own a business that's growing relative to one that's not. I'm just sensitive to the price that I'm willing to pay for that growth. And I think in the Australian market, given it's not a big market, there's a bit of a scarcity, I guess, for those high quality companies. So they often do trade at quite elevated multiples. And the way I look at it, again, everyone's got a different way of looking at it, but I tend to look at value of, if it's a quality company that's growing, is there a path over the next 3 to 5 years back towards a market sort of multiple? And if you're pricing in a lot further than that to get back there, I tend to feel that you're taking on a fair bit of duration risk in that assessment. And a really good example of this is CSL, which is obviously a great Australian success story. That stock was trading 2019, $330, high 30s times multiple, and was pricing in a lot of certainty and growth. And what happened over the next 5 years is COVID. No one could have expected COVID, but that put a lot of disruption into the business. The company then made an acquisition which proved to be value destructive, and the share price is now 25% lower than where it was then. And I think that's a really good example that things can change, and when you're pricing in that much down the track, you're taking risks. Like if a company's in a really hot sector, that's naturally going to attract competitors' capital to that industry. Regulations can change. Management can make acquisitions. Management of high-flying companies can feel like they need to deliver on the growth expectations of the market. That's where I think some of the really high multiples you see, and it's important to be disciplined on valuation.
Yeah, I can't. The typical value manager, I don't think, would consider Goodman even at a price to earnings multiple of 16 to 17 times, would they?
No, that's right. Whereas I think, for us, it all comes down to that interplay of quality and value.
Yep.
And if you can get a really high quality business at the same multiple as one that you think's lower quality, well, it's for us, it's a logical choice that you upgrade the quality of your portfolio in that situation.
Yeah. So you've spoken about the process. So much information out there in this day and age, Sean, more than there ever is. I normally ask how much information, but what sort of type of information do you seek to acquire to have the confidence to buy a stock?
Yeah, so one of the, I guess the things that I spend a lot of time doing, especially when I'm looking at a new company that I haven't looked at before, is I like to read annual reports and conference call transcripts if you can get them. And
sounds like fun.
Yeah, sometimes, especially if it's not an overly interesting company. But I think reading like a few years of successive ones in a row, and also then going back and grabbing a couple from, if it's a company that's been around for that long, from throughout its history, is quite a valuable exercise, because it gives you some insight into, I guess, how the company makes money, but two, also the consistency of strategy over that time. And also go and pick a year or two where you knew that the industry or the company was under pressure, whether that was the GFC or a shock to that industry, just to see how the management team talked about it, how the financials responded. And that should give you a bit of a sense of, or gives me a bit of a sense of, I guess, how the business responds in different sort of circumstances. That's the first thing I like to do. I think visiting the assets, or going on the website of the company and trying to really understand how it makes money and what the consumer experience is like is something that I like to do to try and understand the company a fair bit better. And then, if it's possible, speak to competitors, suppliers, to try and frame up the sort of pros and cons as something that I find really valuable. And again, this may be a little bit unique, but for me, and maybe this is either the accounting background or the shorting exposure that I've had, is doing a bit of work on the quality of earnings of the company. So their financials, how does the cash flow match the earnings, and those sorts of things, for me, is a really important sort of tick of the box exercise to do before I get the conviction to go and invest. So it's not exhaustive there, but to me, that's
pretty exhaustive to me. But anyway,
I find that more valuable than spending a lot of time reading some of the sell side sort of research and those sorts of things.
Yeah, good distinction. Something a little bit unique about both the Shares Plus Fund and PIC. people consider them, I guess, Australian share funds, but they can invest in global equities. PIC can own up to 35% in international shares. Sean, what are the factors that will lead you to investing in a global stock over an Aussie stock in the PIC portfolio?
Yeah, so look, I think that having that sleeve there that we can use, and we don't always use all of it, is really valuable for the portfolio. It provides really good optionality.
Yep.
If the Australian market's really expensive, or if we stumble across a really high quality company or interesting investment opportunity, we can give our shareholders and unit holders access to that sort of upside. So what we do and where we do use a sleeve is we don't do sort of big top-down screens and those sorts of things. Where we uncover opportunities mostly is through our research on Australian companies. Yep. So that can be if we're researching an Australian company in Australia and they've got a competitor that's listed, parent company is listed offshore, or if we're overseas traveling and we're meeting with competitors of the company in an industry, and we'll be having the discussion, and often you go over there and try and get some insights back on the Australian company. But if you spend the time actually understanding their business and you realise that it's got an excellent culture, or the management team seem really, really high quality, that's where we've found a few really interesting opportunities. And the other one is just where we've observed business models in Australia that we think will work overseas. And it may seem strange that we feel like we've got an edge in little old Australia over something in Europe or the US, but they're big markets over there, and often some of these companies are not covered that well by local analysts and investors, and therefore having that view on the local business model can sort of put us at an edge. So that's sort of historically where we've picked up our opportunities.
Interesting process. Can you give us an example of an international stock in the portfolio at the moment that you like?
Yeah, so one, I'm sure people haven't heard of this one, but it's a UK-listed company called Howden Joinery. So Howden is
This sounds like a really exciting annual report read.
It actually is. And there's some good graphics in the annual report. So if anyone's bored, you should pick one up. But
was that a pun?
Almost. Howden's is a manufacturer and distributor of prefabricated kitchens.
Yep.
And it's got a fantastic track record. The company started about 25 years ago. It was founder-led, and he was in the business up until about 6-7 years ago. And it's gone from basically 0% share, and it only services the trade as opposed to direct to consumer.
Okay.
So the builders are their customers, and it's went from 0% market share, and it's now the very, very dominant player in the UK kitchen market. And I guess the secret sauce of the company and what's driven that success is that combination of the vertical integration, so where they manufacture the product themselves and then distribute it themselves again through a decentralized depot model where the local depot managers have got a lot of responsibility. They have a line through a profit share. They deal directly with the builders. And that combination means they can provide really low-cost product to the builders at high-quality service levels. And the stock, again, very successful over a period of time. It's had a tough couple of years. The UK kitchen market's down 20-25% from where it was in 2022. And naturally, that business, when you're a dominant player, has come under pressure, both from a sales perspective and a margin perspective. What we really like about it is during this period of industry pressure, they've continued to invest in the business. So they've continued to roll out 30-plus new depots a year in the UK, continued to invest in manufacturing capacity at the same time as their competitors are pulling back and shutting depots. And for us, they've taken share over the last couple of years, and we think that share has really been hidden by the fact that the overall industry is so weak. So we're starting to see some green shoots now that the industry is starting to pick up a little bit over there, and we think that it's really well set up for that business now as we head into, I guess, hopefully an improving kitchen market. Those market share gains will really start to improve over time. And it's when we bought into it was sort of 14, 15 times earnings, net cash balance sheet, high quality business. And I guess that cyclical pressure has given us an opportunity to buy it at a good price.
Seems to tick all the Perpetual boxes.
That's right.
Yeah. Talking through a recent comment was around potentially US valuations appearing a little bit stretched, the Aussie market presenting slightly better value. Can you perhaps talk us through the thought process behind that, Sean?
Yeah, things moving around a fair bit at the moment. So, but I think especially with the rally more recently, my view would be that both markets at the sort of index level are screening pretty expensive relative to history. But I think the real sort of story at the moment is what's happening underneath the index and just the really wide dispersion in both share price and multiples between, I call it the haves and the have-nots. And what the reason that's happening is the dominant driver of markets and factor in markets over the past sort of 12 to 18 months has been momentum. And what I mean by that is if a company is typically large cap, going well, defensive earnings stream, it has some positive earnings revision, it's attracting a lot of buying, almost irrespective of what the price or the multiple is. And on the other side, if a company's got a bit of uncertainty, it's had an earnings downgrade, there's almost no price that investors want to be there. And I think compounding that a little bit is just the movement of money flow at the moment. I think we're seeing a fair bit of money come into Australia away from the US, and that's naturally finding itself at the sort of top end of town, and even some of the shift of money between active and passive is also sort of compounding that a little bit. So I think the fact that you've got that really wide dispersion does, for us, highlight that there is some really attractive opportunities in certain parts of the market, especially some of the stuff that's been left behind. So that's where we're spending a lot of time, I guess, turning over some of those rocks and seeing if there's some sort of really good value opportunities in there. I do think, especially given what's going on globally, being quite selective and being very disciplined on ensuring that any of those investments do have strong balance sheets and strong management teams, just in case some of the earnings pressures last for a little bit longer than what you expect, that the company's in a pretty good place to withstand that.
Now, I know you guys are stock pickers. Can you talk us, are there any sectors or industries that you find appealing in the Australian market at the moment?
There's a couple. I think one area that we've sort of been attracted to over the last 6 to 12 months or so is the property sector. 2022, 2023, 2024 was almost a perfect storm for the REITs. And it's been headwind on headwind. You've had obviously higher rates. The first thing is, so for retail and office in particular, you've had demand issues whether it was office, the whole work from home thing during COVID, retail, you had stores shut in the lockdowns. It's put a lot of pressure on demand, and that was being compounded by, obviously, in a rising interest rate environment, you get the double whammy of pressure on asset values. So the book values, NTAs of the REITs have been falling, and they're all pretty heavily levered with a lot of debt. And naturally, as interest rates are rising, that then means that the interest costs they've got to pay are going up as well, which means their cash flow is lower, their ability to pay dividends is lower. So it really has been, I guess, a bit of a perfect storm for the share prices. And you've seen asset values fall when share prices gone from premiums to asset values to discount to asset values. So there's some very, very tough few years. The reason I think they're starting to look interesting and have been interesting over the past sort of 2 months, I think there's signs that almost all of those headwinds are stabilising, and there's some green shoots in certain areas. So from the demand side, I think demand for retail is pretty strong at the moment. There's a few big retail groups that are trying to roll out new stores, and there's just not a whole lot of space. In office, still challenging in certain markets, but we're starting to see occupancy rates improve a little bit with some of the return to work sort of mandates that are pushing through. And I think the outlook for that sort of demand supply dynamics also improved over the next few years. Like if you take a retail mall, for example, there's just no supply growth of new mall space in Australia. One, because it's very hard to find the land, and two, because construction costs have gone up so much with all the inflation that it just doesn't make sense economically to go and build a new mall. And similarly for office, even in Sydney core, like if you wanted to, in the middle of prime area of Sydney CBD, if you wanted to go and build a new office tower, you really need rents 20 to 30% above where they are at the moment in the market to justify getting a return on that thing. So I think a combination of that improvement in demand and also what looks like pretty limited supply growth over the next few years should be pretty positive for the underlying sort of dynamics in the industry. And adding on top of that, obviously we've had the start of the rate cut cycle. If we continue to get any further rate cuts, that will probably support asset values, and the lower servicing costs should support dividend growth moving forward. So I mean, it was a tough few years. I think the sector valuations came down a lot. They've had a bit of a bounce back, but we think these cycles in property tend to last for a while. So that's one where, especially relative to an expensive index, looks quite interesting.
I think it goes without saying we're in a volatile political and geopolitical environment at the moment. And without getting sort of bogged down in talking about that, must be a really challenging time for a stock picker.
Yeah, look, absolutely. I mean, there's no shortage of sort of risks, whether it be macroeconomic or geopolitical at the moment. I feel like that's always the way, but it does feel like it's heightened at the moment. In a way, being bottom-up stock pickers like we are, we're a little bit, I guess, insulated for that, where we do tend to make calls from a bottom-up basis. So we're not making our investment decisions based on the macro, but we do pay very close attention to how any of these risks can, one, impact the stocks themselves, but also the fund construction overall. So a couple of, I guess, things that are front of mind at the moment. I think domestically, from an economic perspective, we've still got quite strong wage growth, and even the 3.5% announced a couple of weeks ago for next year for the award. That's a very healthy rate for the employees, and that's really good for companies that are got workforce heavy businesses and cost base. If they're not growing their revenue at the moment, it's tough. And I think that risk is still there. So it's something front of mind for corporates domestically. And then, look, offshore, it's really for us driven by what's happening in the US, and that sort of balancing act between the budget's still running at a really strong deficit. They're trying to cut costs elsewhere, tariffs, and the interplay of all those things, just how that infects the interest rate outlook, currency outlook. Again, no macro expert. I don't make huge calls on that, but do spend a lot of time thinking about, okay, well, if rates didn't go down like the market expects, how does that affect each of our holdings in our portfolio, and also the portfolio as a whole?
Question that almost all investors ask, the process around downside protection and capital preservation. Obviously, investing in the market, nothing is guaranteed, Sean, but how do you think about capital preservation and downside protection, particularly in an environment like this?
Yeah, look, I think the starting point for us is becomes the balance sheet part of that and management part of our filters is something that I think is really, really important in an environment like this, because I think if you have something where there are a lot of risks, and if something does change, having a company with a strong balance sheet, in my mind, provides a level of protection where you're not going to get yourself into trouble that they're going to need to raise equity and permanently impair the capital, or if you've got a strong management team, that they're not going to be pressured into making decisions just because something's changed in the business. So I think having that as a core part of the portfolio construction helps somewhat with capital preservation. The other thing I think, though, at the moment is, as I mentioned before, multiples and valuations, especially in some parts of the market at the moment, are extreme. So there's a number of the sort of top 50 stocks where their multiples and valuations are way beyond where they've ever traded before in history. And a lot of these companies have got what investors perceive to be defensive earning stream, which is why they're in a uncertain world we're in, why they're in such high demand. For us, you can have a defensive earning stream, but when you start paying 35, 40 times multiples for it, our view would be that that's not an overly defensive investment, because at some stage we expect that valuation will return to more fundamental levels. So being disciplined on valuation and knowing what we own in the portfolio, that the valuations still stack up and that the growth's there to support those valuations plays a big role in that capital preservation. The final thing I think that plays into it is to keep an open mind about all the risks that are out there. And this comes back to scenario testing, but it's very easy to get caught up in the headlines about risks and the market's running at the moment, so it feels like the market's going to continue to look through some of these uncertainties, but keeping an open mind and always thinking about, well, what happened, how would the portfolio react if this risk did play out in that way? I think it's another thing that we pay close attention to.
Yeah, and when you're buying, even if it's a defensive business, if you're paying a really high multiple, you need some pretty serious earnings growth for it to sort of grow into its multiple, don't you?
That's our perspective on it, and history has shown that you do get these periods where valuations distort from sort of historical levels or fundamental levels where the future growth of the cash flows justifies those valuations. There's a big chunk of our market where it's not sitting in that level at the moment. So we're being pretty cautious around how much exposure we've got to those sorts of names.
Now, speaking of high multiples, Sigma's a position in the portfolio. Interesting business. I can't imagine there's a heap of value type managers on Sigma's register. How do you perceive Sigma and the recent merger with Chemist Warehouse? And I guess what's the investment thesis for holding that stock at the moment?
Sigma or Chemist Warehouse? I guess for us it's more Chemist Warehouse than Sigma these days. But Chemist Warehouse
I'm sure they'll
itself,
change the name at some stage.
probably. It's been a company we've watched and admired for a long time, even as it was unlisted. And I think there was always an expectation at some stage it was going to come to market. And look, it's a business that we think is one of the highest quality companies in Australia. It's founder-led. The model itself is a category killer where they're trying to offer consumers the lowest possible price. And as the business continues to scale and get bigger, their ability to source goods at a cheaper price improves, and the model then suggests that they give that back to customers at a lower price, which ultimately makes them even more competitive and continues to grow the share. The other thing I think, which is a bit of people often look at Chemist Warehouse as a retailer. For us, the listed vehicle itself is a franchisor as opposed to the actual pharmacies themselves. And franchisor as business models can be extremely powerful because they're very capital light. They're not taking on the leases themselves. That's with the franchisees, and it's very scalable and very high return on capital. The key thing when looking at a franchisor for us is the health of the underlying franchise network. And if you look at the unit economics of a Chemist Warehouse store, it suggests that the overall model and the health of those franchisee systems is very, very strong. And what's that really driven by is the sales per square metre. You walk into a Chemist Warehouse store and you'll see there's product absolutely everywhere. When you walk down those aisles, and they're very, very productive retail spaces. So we think it's a very, very strong underlying model underneath I guess Chemist Warehouse is the franchisor. In terms of growth potential, if you look at their latest results, they're growing same store sales growth running very, very strongly at over 10%, which is one thing. But if we look at their ability to continue to roll out new pharmacies within Australia, if they take the penetration of Victoria across the rest of the country, there's a potential for them to double the store network in Australia. So there's still a lot of growth potential here in Australia. And then if we look offshore, the model's been very, very successful in New Zealand, and they launched into Ireland just pre-COVID. And then so there was a couple of years there, it was hard to get a read, but more recent trends suggest that the brand there and the models got some pretty positive early traction. And we feel that if they can prove that out, that all of a sudden this business won't just be growth in Australia, but it will have offshore growth potential as well. And it's rare in Australia. It is very hard to come by for high quality companies that have got offshore growth potential. So the combination, I guess, of such a high quality business model with really clear pathways for growth puts it in rare air in the Australian market. And we think that that plus then talking about the combination with Sigma, the wholesaler, distributor of pharmacies, there should be a lot of synergies there for them to unlock. So we expect there's going to be really strong earnings growth over the next sort of short, medium and long term. And the stock's clearly had a very positive run over the past sort of 6 months, and the headline valuation is up there. When we originally sort of bought it when the deal was announced, but when there was still some ACCC risk. So we were taking some risk on there that it wouldn't complete. We had a view that it would, and if it did, the market would reflect the quality of the business in the share price as it has. Clearly near-term multiples are very expensive. We're still holding on to some of the position because we think it's got a really attractive growth runway.
A couple of other high conviction ideas on the ASX that you like as well, Sean, at the moment?
Sure, many people are familiar with this is News Corp, which is a business that's obviously been around for a long time and changed the look and feel of the business over in terms of what it actually is. It's a very
different business to what it was, isn't it?
Very different. It used to be a lot of it was the news and media mastheads, the newspapers in Australia. If you look at it today, it's still a collection of assets, but the core asset is it's 61% stake in realestate.com, which is another very high quality business in Australia. The core thesis for us, though, in terms of why we own it is actually the XREA asset. So that's made up of Dow Jones, which is a B2B software business, super high quality, very high growth, and the Wall Street Journal newspaper masthead in the US. And I think one thing that the market's failed to reflect in the share price is just how much higher quality the Wall Street Journal earnings are now versus what they were 10 years ago. That business used to be very reliant on print revenue, so actually printing the newspapers and also advertising, which is quite a cyclical revenue stream. It's now completely transitioned to be heavily subscription-based and digital-based, and that's a much higher quality earning stream. There's also the books business, HarperCollins, which spits out a lot of free cash flow, and they still do have the news and media mastheads, but it's a very, very small part of the business. one thing that they recently sold their Foxtel business.
Yep.
And for us, that's quite an important point for the company for a couple of reasons. Foxtel was largely ex-growth, so it was a drag, and it was actually going backwards a little bit from an earnings perspective, which did drag on the overall growth of...
Pretty easy to work out why with all the streaming services.
That's right, yeah. There was some structural headwinds there, but it was also very capital intensive. So now with the sale of Foxtel, you're left with the News Corp business overall, which is in a net cash position. So there's lots of scope there for them to go and do M&A deals, which historically they've been very good at. And there's also, with Foxtel out of that earnings base, the overall growth of the company we expect to accelerate. And with the Wall Street Journal business now largely digital and subscription, they've got the ability to start to push price and really generate strong earnings growth out of that business. So we see a lot of value in the sum of the parts within News Corp, and particularly in the ex-REA stake.
A lot easier business to understand than what it was once upon a time.
Absolutely, yeah.
Maybe one more on the ASX?
Yeah, another one which is a lot smaller than News Corp, but one we think is a really interesting story is Cobram Estate Olives.
Goodness me.
Yeah, I'm sure some people might have a bottle of Cobram in there.
Yeah, I do at home.
In their thing. But look, Cobram's a really interesting Australian company, and it's one of the rare examples of where you've had a primary, like an agricultural product and a brand being developed off the back of that. And that vertical sort of integration is not something that many Australian companies have been successful in doing.
Yeah.
But look, Cobram has over 7,000 hectares of olives grows in Australia. It's 70% of the olive oil production in Australia, and their two brands, Cobram and Red Island, are close to 40% market share, value market share in the supermarket. So it's quite a high quality franchise, and the founder is still the chairman, owns over 15% of the company. So it's got that founder-led sort of culture that we really like. They've also got a small but growing business in the US, over 1,000 hectares of olives there. The reason that we think it's really interesting at the moment is for two reasons. The Australian business has undergone a pretty large capital investment program expansion over the last sort of 5-6 years. They've invested in a lot. They've put a lot of new groves in the ground and also invested in some extra processing capacity. And when you plant an olive tree, it takes 7 to 8 years for that tree to become fully mature and productive. So now they've invested all the capital. We've got this really nice period over the next 5 to 7 years where we're going to get a lot of volume growth without any extra capital put into the ground. And as that volume grows, they're starting to fill up all the processing capacity they've got, so the margins should increase at the same time. So we expect earnings and free cash flow out of the Australian business to have really nice growth from here over the next sort of 5 to 7 years. And that will then enable the company to continue to invest in the US business, which is showing really promising signs that it's on a similar pathway to the Australian business, where they're got distribution in over 15,000 supermarkets. The brand's getting a lot of traction, and they're farming over there. They're getting similar yields to Australia. And for us, at the sort of current valuations, we're paying nothing for that US opportunity, which clearly has the potential to be much bigger than Australia over time. So it's one that's flying under the radar a little bit, I think, here in Australia, but a business that's very well run and we think's got a pretty attractive.
Yeah, you talk about flying under the radar. I love the breadth of stocks that we've spoken about.
Yeah.
Goodman, which is obviously a top 10 stock on the ASX. We've also got Chemist Warehouse and Sigma. We've obviously got Cobram as well, and News Corp. Sort of we're dealing with a really big end of town and quite a small end of town with Cobram as well. So that opportunity set for you guys is quite wide.
And that's right. And yeah, for both the funds, it's we've got the ability to go across both internationally and in Australia, right across that market cap spectrum, which enables us to reflect, I guess, our views and where we see value and put that in the portfolio, which I think is a really nice balance.
So we're going to look through all the white noise at the moment. Are there structural or sector trends that you're seeing at the moment that get you excited about investing for the long term?
Yeah, something I haven't quite worked out if I'm excited about it yet or concerned about it. But I think one thing that's really interesting is just AI, and I know a lot of people are spending time focused on it. For me and us, it's less about the direct sort of companies that are exposed to AI. So I'm not talking about your technology providers. I mean, we've got some Goodman, obviously, which gets the benefit of the data center theme. But what's really interesting and exciting, I think, is how does this play out in terms of the actual applications
within companies?
Within companies, and whether that be, for example, is the travel sector the travel agent sector negatively impacted by AI? In 5 years' time, are we able to go on to AI engine and say, I want
plan a holiday for me
to go to Europe.
I already do
South
that. I already
Africa.
do this with myself when we travel as a family. I'll say, can you please tell me what to do for 4 days in this part of the world rather than using a travel agent.
And at the moment, for the complex travel that people do, they still do, and a certain generation will still rely on travel agents. But if AI can go and scrape all these things and get the best price and do that instantly, does that bring into the question the sustainability of the travel agent? I don't have the answer to that yet, but I think it's quite an interesting, and there's many other sectors that are similarly exposed, but trying to understand, I guess, the threat that may, or opportunity that may present is something that we're spending a lot of time doing. I think also old school businesses that have got a lot of costs, a lot of simple processes, if they're a fast mover and they go and implement AI and that it could be a really big cost out opportunity for them, or it could be a risk if they're behind their competitors. Similarly, it could be a revenue generating opportunity for some industries if they've got a really rich data set that they can go and scrape and offer that product to investors. So for us, it's don't have the answer yet, and I think it's still really early. So my view would be that over the next few years, we'll start to see the actual applications accelerate in terms of what that can do. But understanding now how the company's going about their approach to AI, I think will be quite impactful in terms of how that all plays out over the next few years.
Skeptical when all these companies talk about the benefit of AI for their businesses?
Definitely skeptical, but it's very easy to say it.
Yeah. We're going to improve efficiencies by X because of AI.
That's, absolutely skeptical. And I think we're probably at the point now where we'll start to see proof of that, where they're going to need to start showing that these sorts of tangible benefits. And that's why I think it could be a really interesting dynamic and trend over the next few years as to how that
some big winners and some big losers as well. Beautiful. Thank you, Sean. Fascinating discussion. Thanks so much for joining us today on our podcast.
Thank you very much.